One of the best ways to offset stock market risk is by owning investments that go up when stocks go down. Everyone thinks of gold as being one of those investments. But what goes up when stocks go down? And does gold always go up when stocks go down? In this video, that's what I'll be talking about. I'll be going back and looking at past bear market or stock market crashes to see what gold did and how it's worked as a way to protect our portfolios during bear markets. Hi, my name is Camille Gaines. Welcome to Retire Certain. This channel is all about helping people build wealth with slightly alternative methods that don't take decades and creating diversified income streams so you can live well. I'm not a financial advisor, so I'm not trying to sell you wealth management services or act as a financial advisor. I'm a bit of a financial nerd and I'm an accredited financial counselor. But mostly I just share here what I've learned from personally investing for almost 40 years and from creating diversified income streams for the past 15 years. So as a disclaimer, I must say do your own research and hire a financial advisor if you feel like you need one. Now, back to gold as a way to offset stock market losses and protect your investment portfolio. I remember that gold did not go up when stocks went down in 2008, at least not in a clear-cut fashion. My memory was that in 2008, gold was volatile as investors feared the demand for gold would be down on a global basis. So I did some digging for an article I wrote recently at my website, retirecertain.com. In hindsight, it was a little more complex, as you're about to see, about what happened with gold in relation to stocks in 2008. So, did gold go up when stocks crashed in 2008? Here is how gold performed in 2008 according to data at usagold.com. Gold prices on January 1st, 2008 were $833.50. Gold prices on the end of the year, December 31st, 2008, it was $880.15. So there was an increase in the price of gold in 2008 of almost $47. On a percentage basis, gold went up then 5.6% in 2008, while the S&P 500 index dropped about 38.5% that very same year. This means that gold was an effective hedge against the stock market decline in the year 2008. But again, insightful investors did not have a smooth ride in 2008, and here's why. During 2008, gold went as high as just over $1,000 on March 17, 2008, and then it went as low in late October down to about $723. So high around 1,000, low around 722 in 2008. That's a pretty wild ride, right? Nevertheless, gold was an asset that did go up when stocks went down for the calendar year in 2008 based on where it was, the price it was at the beginning of the year and where it ended the year. Now, if gold is such a great hedge, why didn't it go straight up when stocks crashed and be, a little more consistent with that? Well, for one thing, the price of gold is strongly affected by the US dollar, which adds another layer of complexity. Perhaps even more important, maybe, gold is a source of funding for margin calls made on declining assets, as explained in a Seeking Alpha post by Plan B Economics. It was really good, and this is kind of nerdy, but it made a lot of sense. This fact leads gold to experience forced selling at times. Much of the reason why gold was so volatile when stocks fell in 2008 was due to borrowing and selling of gold on the market so banks could meet the required liquidity requirements during the financial crisis. Now, that's pretty complicated, right? So gold is it's kind of hard to understand. Gold versus stocks historically, though, how has gold done historically in other bear markets? Well, gold has actually gone down during some of them. In fact, gold went down when stocks were down in both the 1980 bear market and the 1998 stock market correction. It wasn't really a bear market, but it was a correction. This shows, though, that gold is not always negatively correlated to stocks. Investing, it's a probability game. You may have heard me say that before. We don't know anything for sure when it comes to investing our money. We can just use probability to say, this is probably going to happen based on historical data, facts, and math. We can logically predict what's probably going to happen in the future. So we can have some kind of plan to have more money than we have years that we're alive, right? So how has gold done overall in past bear markets then? So we can use this information to plan, to see what's probable in the future. Gold price movement was negatively correlated in 6 of 8 stock bear market declines, or stock market declines of 19% or more since 1976. This means gold went up when stocks went down in 6 out of the 8 bear markets since 1976. That's pretty good probability. Not great, but it's pretty good. If you want to know more about what goes up when stocks go down, watch this video next. Remember, build wealth, create income streams so you can live well.